A financial structure operates beneath most people's daily lives, and it isn't hidden by accident. It simply isn't taught. Those who understand it use it consistently, while those who don't remain confined to earned income. The tax code was not designed to reward employees. It was designed to reward ownership. The moment you own productive assets, even a single rental property, you enter a different set of rules. This is the owner's framework. Acquire assets, grow equity, avoid taxable sales, and compound capital. Wealthy individuals do not build wealth by repeatedly selling appreciating assets because selling triggers taxation, taxation reduces capital, and reduced capital slows momentum. Owners think differently. Consider buying a property for $400,000. It generates modest monthly cash flow and provides depreciation, an annual deduction that reduces taxable income even if the property increases in value. Years later, it's worth $500,000. Most people sell and capture the $100,000 gain, but that gain is taxed, often at 15 to 20%, leaving less capital and no asset. Owners avoid triggering that tax event. Instead of selling, they refinance. If the mortgage has been paid down and the property has appreciated, a lender may allow borrowing up to 75% of the new value. That refinance can release significant cash. Borrowed funds are not income, they are debt, and debt is not taxed. The asset remains in place, still producing cash flow and appreciation, while the extracted capital is redeployed into another asset. Acquire, appreciate, leverage, repeat. This cycle compounds because it avoids resetting through taxable sales. Equity becomes the fuel for expansion. This principle is widely used by high net worth individuals such as and. Rather than liquidating large stock positions and triggering substantial capital gains taxes, they borrow against their holdings. The assets remain intact, liquidity is created without taxation, and upon death, heirs often receive a step-up in basis that can eliminate unrealized gains for tax purposes. This structure is legal and embedded in the tax code. For many people, real estate is the most accessible entry point into this ownership model because it combines leverage, cash flow, appreciation, and depreciation. There is also a provision that can significantly change the equation for active participants: short-term rentals. If you materially participate in managing a short-term rental, the IRS may treat it differently from a passive long-term rental, and that distinction matters. Losses, including those created through accelerated depreciation, can potentially offset active income. Through a cost segregation study, a portion of a property's value may qualify for accelerated depreciation in year one. Instead of spreading deductions over decades, a substantial amount can be taken up front. For example, with W-2 income of $100,000 and estimated taxes of roughly $18,000 to $22,000, purchasing a $500,000 short-term rental where $125,000 qualifies for accelerated depreciation could generate a paper loss that offsets the $100,000 in income, dramatically reducing taxable income.